Rick Rule, President and CEO of Rule Investment Media and co-founder of Battle Bank, and certainly a friend of this show and someone we look forward to having on every quarter. It is so great to welcome you back on the show and great to see you as always, Rick.
My pleasure. I'm flattered to be invited back. Thank you.
Oh, well, this audience loves you and I love having you on. I love talking to you and learning from you. And it's just an absolute treat. And we are recording today. It's January 14th. I don't think you're our last guest. Actually, you know what? You are going to be our last guest, the episode that will air before the inauguration as well. So we'll just leave it at that. But I would love to start where we always start, Rick, and that is more of that big picture, macro view, where we are today as it relates to, the global economy. We can throw in the domestic economy, of course, and markets. And as you know, Rick, you can take all the time you need to set the table when it comes to that big picture, macro view.
I replayed our last interview, and surprisingly, we got it fairly right.
Yes, you did.
I continued to be surprised pleasantly by the relative strength in the U.S. economy and even by the relative strength in the global economy. If you think about the challenges that the global economy faces, a war in the Ukraine, a war in the Middle East, increasing economic nationalism around the globe, which normally makes all people poorer, greater taxation relative to GDP, greater debt relative to GDP. There's a lot of reasons why the global economy might curl up in the corner of the room in fetal condition and just sort of moan and wail. But the truth is that we struggle through. The U.S. economy, too. I need to say that the U.S. economy is an economy that increasingly works for people like me, and not so much for other people. An economy that has been exposed to globalization so that people who don't have the skills to compete on a global level are seeing their real standards of living deteriorate. An economy, too, in the United States where artificially low interest rates, penalize savers, reducing the amount of money that they get on their savings while subsidizing investors like myself, people who have access to credit and the education as to how to use it. So I understand that one of the problems with our economy, and in fact the global economy, is that a whole bunch of people aren't participating. That notwithstanding, a whole bunch of people, investors and people with access to credit, are. And I am still surprised by the relative strength. I do note that there are some warning signs in the economy, and those warning signs are more pronounced they were than the last time that you and I spoke. One example would be in the U.S., where the Fed has reduced the short-term interest rate, but the market hasn't listened. The yield on the long bond has gone up. I've seen this happen 4 times before in my career. And these weren't the promises of good times ahead. This is the investor saying, irrespective of where the short-term rates are, inflation is rearing its ugly head. And the idea that I'm going to be contented with a 4% yield some years out, given the fact that the rate of deterioration of the purchasing power of the U.S. dollar is increasing, the probability of that is nil. That's not a good sign. When the Fed loses control of the long yield, when the market reasserts control of the long yield, that's often a harbinger of more challenging times to come. 2, when you look at the U.S. stock market, which, if you only look at the indexes, shows some signs of strength, that ignores breadth. Most of the breadth in the S&P 500 is comprised of 10 or 12 stocks, the sort of NVIDIAs of the world. And when you look at the breadth in the rest of the equities market, one becomes challenged. The flip side of that, and I know you want a definitive conclusion, which I don't have. The flip side of that is that the equities market isn't as overpriced as one thinks it is. Value stocks, community bank stocks, small cap stocks, out of favor stocks are, if you use the metric earnings or cash flow relative to enterprise value, not as expensive as the S&P 500 looks. And in that sense, maybe we will ultimately get broader breadth. Or if we have a circumstance where major equity markets decline, maybe you'll see a circumstance where the out of favor stocks in today's market decline by less than the glamour stocks going forward. Notice, of course, by the way, Julia, that I hedge my bets by saying maybe.
Yeah,
The truth is, when you're looking at the future, you're talking about a range of probability.
exactly. That's the thing. You're right. It is probabilities, definitely not certainties. No one knows. And I think we have to remind ourselves of that too, that these are probabilities.
We suggested in our prior interview that the stage was set for a higher gold price.
Hmm.
And surprisingly, we got that right too.
Yeah. Can you walk us through the arithmetic of the gold price?
Yeah, the arithmetic is ugly. I mean, if you're thinking about the arithmetic in the context of why the gold price is rising, uh, gold prices usually rise when people are concerned about the maintenance of purchasing power in fiat currency denominated savings instruments. On a global basis, the world's reserve currency is the US, and by default, the world's preeminent savings instrument is the US 10-year Treasury. So let's look at the arithmetic just around the Treasury. The first thing to say is that the current deterioration of the purchasing power of the US dollars is measured conventionally by something called the CPI, the Consumer Price Index. And I would argue with you that the CPI is a very inefficient measure of the deterioration of the purchasing power of the US dollar. If you believe the CPI, it would suggest that the deterioration, Julia, of your savings is progressing along at about 2.6% per annum. I think if you examined your own personal finances in the period, say 2000 to 2025, a 5-year period, and you thought about how your health insurance premiums had changed, or how the price of your groceries had changed, or how, if you're a homeowner, mortgage interest rates have doubled, or if you're a renter, what has happened to your rents? When I run that same exercise myself, and by the way, I'm an old cheapskate who doesn't spend very much, I find that a deterioration of my purchasing power is more like 7.5% per annum than it is 2.6% per annum.
Mm-hmm.
I would urge your listeners to think about their own spending patterns and whether 2.6 represents the level of the deterioration of the purchasing power of their savings that they've experienced. If you use the CPI number, the arithmetic around the US 10-year Treasury isn't bad. You're getting paid 4.5% a year in a currency where your purchasing power is declining by 2.6%, which means you're getting almost 2% real yield. If by contrast you use the 7.5% number, that is, you're getting paid 4.5 in a currency that's depreciating by 7.5, you're losing 3% a year. The concept of investing in a riskless asset, a US 10-year Treasury, where your purchasing power declines by 3% a year, compounded over 10 years, is
Mm-hmm.
not very attractive.
Mm-hmm.
Let me restate that. It's extremely unattractive. And this is precisely the circumstance where gold does well.
Yeah.
And gold has done well.
Yes.
The second part of gold isn't so much arithmetic as narrative, which is to say the preeminent buyers of gold in the last 3.5 years haven't in fact been Americans concerned about the deterioration of their savings, but rather foreign governments who object to two things: the weaponization of the US dollar and the weaponization of the SWIFT banking system, which is to say the US government's attempt to use the US dollar to enforce its policy prerogatives elsewhere. Other countries object to that. And two, a return to that arithmetic. If you're China and you have $3 trillion in US treasuries, and you look at being paid 4.5% in a currency where the purchasing power is declining by 7.5%, it seems like a lousy deal, particularly when that's compared and contrasted with selling your US treasuries and using the money to make investments in your own economy. The Chinese, of course, have done both, made investments in their own economy and bought gold. And I think what you're seeing there is the hegemony of the US dollar challenged, often in favor of gold. One final piece of arithmetic, Julia, which we talked about 3 months ago, but some of your listeners won't have had the good sense to listen to us 3 months ago. That is this: gold is really, really, really underowned historically. JP Morgan Chase suggests that the market share of precious metals and precious metals related securities is less than 0.5% of total savings and investment assets in the United States. In other words, an infinitesimal market share. The 4-decade mean market share is estimated by JP Morgan Chase to be 2%. So gold doesn't have to win the war against the US dollar. Gold doesn't have to demolish the treasury markets like some gold bugs suggest. All it needs to do is return to mean. If it returns to mean, demand for this asset class increases fourfold. One can only guess what a fourfold increase in demand would do to a commodity where increases in supply are extremely limited. And that's precisely what I think is going to happen and continue to happen.
Yeah. You're not a price target guy, though, if I'm correct.
When I was younger and dumber, I was. Warren Buffett famously has said that if you spend 15 minutes a year predicting markets, that's okay. But anything more than that is a waste. He suggests that there's so many variables that you're trying to know the unknowable, that you can allocate 15 minutes a year to your amusement if you regard it as just amusing. Given that Buffett is way smarter than I prefer to tag along with his refusal. I can tell you this, Julia, if you're looking for a headline, which you're probably not.
Oh, we love headlines. Come on, Rick.
I don't own gold because I think it might go from 2,700 to 3,000. I own gold because I'm afraid it's going to go to 9 or 10,000.
Yeah.
Why do I say that? The last time that we had sustained deterioration in the purchasing power of the US dollar was the decade of the 1970s. In that period, 1970 to 1980, back to arithmetic, according to the Office of Management and Budget, the US dollar lost in excess of 75% of its purchasing power, which is to say, at the beginning of the decade, what was $1,000 worth of goods and services, by the end of the decade would have cost you $4,000 to buy. During that period, the gold price went from $35, admittedly a price-controlled $35, to $850. And I think passes prologue. I don't see any reason, any way, with the on-balance sheet liabilities of the U.S. government at $36 trillion, and with the government's estimate of the net present value of off-balance sheet liabilities, mostly entitlements, Medicare, Medicaid, Social Security, exceeding $100 trillion, that is to say, with net government debt over $130 trillion, I don't see any way out of this circumstance other than inflating away the net present value of those obligations, just like the decade of the 70s. And that means likely not merely higher, but much higher gold prices.
Okay. I like that quote about owning it because you're afraid it could go to 9,000. Like, okay, let's just pretend that we live in that kind of world and it goes there. Like, what does that look like? How would you describe that environment, or what happens if we get there? Like, from, I guess, probabilities, but that would be a very unpleasant world and environment to be in if we get to that kind of fear that you lay out.
The decade of the 1970s and late 1960s was in many senses unpleasant. People on fixed incomes, people who relied on their Social Security, found themselves getting Social Security, but they found that their check every month bought less than it bought the month before. When savers took control of the interest rate market, people found that the interest rate paid on their first mortgages went from 5.5% to 17.5% or 18%. Pretty unpleasant. And people who owned long bonds got killed. Somebody who owned a really riskless instrument, which is to say a 30-year U.S. Treasury, where their income was guaranteed for 30 years, found that the capitalized value of their 30-year bond in the decade 1970 to 1980 declined by 70%. So holders of long-term debt got massacred. People on fixed incomes got massacred. Salary earners, where their skill set didn't enable them to price their labor relative to the price of capital. That is to say, employees that didn't have skill sets that allowed them to raise their rates, also in terms of their purchasing power, got massacred. One consequence of that was massive social division in the United States. I'm not saying that we're going to see a return to domestic violence, but I'm not saying that we aren't either. When people are resentful and they're looking for a cause of their resentment, they very seldom look in the mirror. They most commonly look elsewhere. And my hope is this. My hope is that my caution around debt and deficits is wrong. Hope is that the requirement for working people that they have contestable skills. I hope that's wrong. My hope is I'm wrong about the gold price. A $9,000 or $10,000 gold price implies a lot of things about the way other assets in society perform. It implies a real change in one's lifestyle. And my lifestyle's great. I would really, really, really like it if I was able to say, God, I got that one wrong. We got through it fine. The debt didn't matter. The deficits didn't matter. Contestability didn't matter. I just don't think that's the case.
Yeah. I mean, I'm looking right now, Rick, 36.35 trillion for the US national debt. I'm looking at like the largest budget items, all just ticking higher. The interest on the interest on the debt north of $1 trillion. I mean, you're an arithmetic guy. Are we past the point where is there any way that the math could work out, or are we just kind of past that point?
I sure don't know it, because the 36 isn't the problem. It's a problem.
Is it the off balance as well?
The off balance sheet.
Yeah.
Julia, look at me. I'm the problem. Okay. I'm almost 72 years of age. Medicare, Medicaid, Social Security. My generation voted ourselves all kinds of cool benefits. We took the money, we spent it, and we're leaving y'all a bill. These entitlements really are an intergenerational transfer of stolen property. My generation doesn't want to think of themselves as thieves. They want to think about the fact that they paid into these programs over the years. They neglect to understand that with Social Security, as an example, all the money that was paid in was invested in federal IOUs. And that money was spent funding current deficits. When somebody says I paid in, I need to say to them, yes, you did. You did, in fact. And that money was misappropriated. It's gone. The fact that you think that you deserve it is interesting, but it's not relevant. And that's going to cause some resentment. I believe, first of all, I believe that they're going to tinker around the edges. I believe that the politicians will have no choice but to say to an old rich guy like me, the cap is going to come off your Social Security contribution. That is, the fact that you don't get taxed for Social Security now on income above $160,000, that's going to go away. We're going to tax you on all of it. And then we're going to means test Social Security, which means despite the fact that the cap came off, you ain't going to get it. Yes, we said it was an insurance program, and we lied. It's not an insurance program. It's a transfer program. The second thing they're going to do, and that's okay. There's very few rich people. It's easy for a whole bunch of people to screw a few people. That works. The second thing that they're going to do, and they have to do it, is they're going to have to change the age that people begin to receive their Social Security. When Social Security was enacted, it provided basically poverty level, subsistence level benefits to people 65 years of age and older. The average life expectancy of an American male in those years was 66 years. So it covered you for a year. That's changed now. The average life expectancy of the median American male is about 80 years, up from 65. And you can begin to receive benefits at 62 unless you're disabled, in which case you can receive it earlier. You follow what I'm saying?
Oh, yes. Yes, I am.
They're going to have to change that. And people are really, really, really going to be angry about that. The final thing, though, because that doesn't matter, changing it around the edges, it really doesn't matter. Like these geniuses, Bernie and AOC and all these people have said, oh, no problem. No problem. Tax the billionaires. Well, gets back to math again. The problem is $100 trillion. And the IRS estimate of the aggregate net worth of American billionaires is $5.6 trillion. So never mind raising their tax. If you stole all their money, you'd solve 5% of the problem. It would not matter. So the way they'll get around it is that they'll honor their nominal obligations to most old guys. Whatever they pay me now, $4,000 a month, something like that. I don't even know. They'll still pay me that.
And do you just automatically get it? Like you can't really opt out of it. You just get it, right?
Yeah, I could opt out of it. In fact, what I do is I donate the money to anti-government organizations.
Because you're a libertarian, I know that.
The organizations that are looking to limit the depredation of government on American citizens. That's what I do personally. Yeah. But what'll happen, I think, is that if you're supposed to get $4,000, you'll continue to get $4,000. But the $4,000 will buy you $1,000 worth of stuff after 10 years. In other words, they will not index your tax to inflation, and they'll inflate away the value of your benefit. That's precisely what they did in the decade of the 1970s. That's one of the reasons why the CPI understates the rate of inflation, because the CPI is the benefits escalator on entitlements. It is in their interest to understate inflation, first of all, because it mollifies citizens who are bad at math, but secondly, because it reduces the obligation that the government has incurred in terms of entitlements. A pretty ugly cocktail, frankly. And by the way, Julia, we'll get through this. We got through the 70s. We'll absolutely positively get through this. The United States is such a vibrant society still. It is still a place where a group of kids commandeer a garage in Sunnyvale, and out pops Google, or out pops Apple, or out pops NVIDIA, you know? I guess what I'm trying to say is that America is still a culture where our individual creativity, our individual tenacity, funds our collective stupidity. I think there's going to be a 10-year reckoning while we sort out how we do that in the future. And I think it's going to be decidedly unpleasant. But we're going to get through it.
Wait, so a 10-year reckoning. Can you put a bit more meat on the bones there?
Yeah, I mean, the decade 1970 to 1980 saw the purchasing power of the U.S. dollar decline by 75%. Mm-hmm. It wouldn't surprise me at all to see that happen in the next 10 years. So you're cruising along, making $100,000 a year, thinking you're doing very well. And when you're budgeting for yourself in 2035, think about the fact that $100,000 will buy you $25,000 worth of goods and services. So plan your savings and your retirement accordingly.
Mm-hmm. Okay, Rick, I know you as a libertarian, correct?
Yep. Yes, ma'am.
So I take it you're not a Trump supporter and you weren't a Harris supporter. I know that. Correct. But it does make me just curious because I imagine, okay, some folks, I feel like they come on and you can definitely tell their political views and whatnot. But right. Okay, as a libertarian, kind of looking at it, new administration taking shape. What is your viewpoint?
I'm delighted that being anti-establishment has become popular. I'm delighted by the protest vote. As to Mr. Trump personally, I read his book, The Art of a Deal. And he believes fundamentally differently than I do. I believe in a transaction where both sides do well. And he believes in a in a winner-take-all transaction, a win-lose transaction. I don't believe in that. I don't believe that Mr. Trump is serious about cutting spending. I think he's serious about rewarding people who give him power. By the way, I don't think he's worse than who he preceded. I don't think he's as good as the people who purport to be his acolytes believe him to be. As to the Office of Government Efficiency, Department of Government Efficiency, pardon me.
Yeah, I wanted to ask you about Doge.
I think that's the strangest form of fiction I've read in many years. The first instance, to appoint the person who heads it, to appoint to that position somebody who has enjoyed literally billions of dollars of subsidies and transfer payments. I mean, Tesla wouldn't exist without subsidies, nor would SpaceX. So to appoint, admittedly, a very efficient hog who is well up to the trough, as to be the person to remove the feed from the trough, seems suspect to me. The second thing, and Julia, you should have this person as a guest. There's a wonderful man named David Stockman.
I've been asking him to come on. I just can't get in touch with him.
I'll help you.
Oh, amazing. Okay. So David Stockman.
David was the director of the Office of Management and Budget in the Reagan years. And he wrote a wonderful book called The Triumph of Politics that all of your listeners should read. The Triumph of Politics describes how the Reagan Revolution, by the way, Reagan had a mandate. He didn't squeak through like Trump did. Reagan had a broad mandate to make government smaller. And Congress, in particular the GOP Congress, derailed the Reagan Revolution in 120 days. I think the chance that the Department of Government Efficiency has to rein in government spending, particularly government spending around entitlements, the $100 trillion problem, is nil. And we have to deal with it. We absolutely, positively have to deal with it. Did you know that it is estimated that the increase in off-balance sheet obligations, entitlements, every year, the increase, in the unfunded liabilities is $2.5 trillion?
I did not know that. $2.5 trillion every year?
And the increase in on-balance sheet liabilities, which is to say the quote deficit, is about $2 trillion a year. So every year this debt pile gets $4.5 trillion bigger. Meanwhile, gross federal revenues last year before spending, all the money the government took in was $4.5 trillion, which is to say the problem gets bigger every year by the total income of the U.S. government. I laugh because the alternative is to cry or swear, something that would be unseemly on your interview.
If the probability is nil that they'll be able to be successful here, can anyone be successful with this? Like, it's like kind of like you want them or hope for something to change or be successful.
Well, I'd do it for them, but I suspect I'd be shot.
Okay, what would you do?
Oh, I would tell the truth, sadly.
Okay, we like the truth.
I'd tell all the intended beneficiaries, too bad. So sad. Money gone. I would probably change the defense budget to reflect the dictionary definition of defense, which is to say the protection of the domestic interest within our borders. I wouldn't have troops in 110 countries. A rule presidency would be truly ugly. A fact-based presidency, one that isn't narrative-based, I think would be extremely unpopular with Americans.
So at this point, all roads lead to inflation.
Inflation, or, there's a different way you can have a monetary reset.
Okay, let's explore that. I'd love to hear more there.
Depression.
Uh-huh.
In other words, in that circumstance, you really truly admit defeat. You say to the $36 trillion in bondholders, sorry, we default. By the way, we're nuclear armed. Try to seize your collateral. We acknowledge that we can't meet the operating expenses of the U.S. government, never mind the entitlement expense. We have a depression. We have deflation. And we reset to the liquidation value of our assets. That seems highly unlikely to me. Americans are by nature positive people, and they would prefer to kick the can down the road rather than call the question. And I think that's what happens. I really, really think that the reset that we have is on the installment plan, like the decade of the 70s. We reduce our individual purchasing power very gradually over 10 years rather than all of a sudden.
Okay, so like an installment plan. Okay.
Yeah.
And that's in the form of the inflation that reduces the purchasing power.
Correct.
Okay. Let me ask you this, because when you look at the US compared to the rest of the globe, the phrase that gets thrown out is we're the cleanest, dirty shirt in the laundry pile.
No, that's very, very, very true. Ironically, my friend Doug Casey says, the US dollar is the worst currency in the world with the sole exception of all the others.
Mm-hmm.
And when I do the arithmetic around most countries, including our neighbor to the north, who I'm very fond of, their math is even worse than ours. Their expectations are lower, and they have not had the ability for 40 years to externalize their inflation by maintaining the world's currency. But with certain exceptions, economies that have very high domestic savings, this problem is global. And the problems, the countries where the problem isn't acute, Singapore, United Arab Emirates, Liechtenstein, to a lesser extent Switzerland, yes, they matter to the residents, but they don't matter to the global economy. The U.S. the U.S. matters to the global economy.
Yeah, it does. I recall, one thing about you, Rick, is I feel like you're really good at looking at like bond math and what's going on in fixed income, because you referenced it at the top of this conversation. I marked it down and I want to go back to it. We've had the Fed cutting rates 100 basis points last year, and yet we've seen the yield on the long bond go up. What in the world is going on, and what is that saying? That's a warning sign. You pointed out that was one of the warning signs. Is that just inflation? Like what? It doesn't make sense to me.
Investors are saying that inflation is different than it's being presented as, and they are requiring a higher interest yield on their savings, irrespective of their cost of funds. Traditionally, if you were a bank and you didn't expect higher interest rates, if the government was willing to lend you money surreptitiously at the Fed rate, and you could reinvest that money in U.S. Treasuries, long-dated U.S. Treasuries, you didn't worry so much about the yield curve because inflation wasn't eating up too much of the purchasing power in your long yields. That's changed. When the market takes up long-term interest rates irrespective of the cost of funds, what the institutional investor is saying, what the big investor is saying is, you have to compensate me for inflation.
Got it. Okay. Could it also be viewed as like, does it signal like a loss of trust or anything like that?
I think less, because I think the big institutional investors, given that they're part of the system, trust the system. I mean, clearly they don't believe the CPI number because they can add and subtract. It's not in their interest to accept being lied to.
Mm-hmm.
They're happy for you to be lied to, but I don't think they feel under any obligation to believe the lies themselves. I think it's fairly naked, which is to say that they understand that inflation is understated, and they also understand, given the arithmetic that I've just given you, that the only conceivable way out is inflating away the net present value obligations. In other words, it isn't just that they believe that today's inflation rate is higher than the inflation rate that's being stated. When they look out over 10 years, they don't see anything that changes except it getting worse.
Yeah. So if the only way out is that you have to inflate your way out, I guess every one of us, like all of us, are going to have to bear that cost then by loss of purchasing power. Things are going to be more expensive. Is that the cost at the end of the day? Like, we're the ones that are going to feel it if inflation's
well, not
the way
everyone,
out?
Julia.
Not everyone?
If you were working in conventional media still, and you were drawing a salary, you would be stuck in this. But you're not. You're building your own business. to the extent that you increase your circulation, and as a consequence of that, you can increase your ad rate or however you get paid, you have non-contestable employment. Julia La Roche can come out of this in much better condition. I came out of the decade of the 70s in much better condition.
Mm-hmm.
But people who don't have contestable lives, people who don't have the skill set to use inflation, that is to say, buying assets that appreciate, or people that don't generate from their own efforts utility that's viewed by the market as being valuable enough that they can raise their rates. Those are the people who are hurt. The people who deliver mail, people who build cars, that kind of thing.
Yeah.
People whose skill sets are being challenged by people with lower standards of living in other countries that will do the same job for less. Those are the people who suffer. And those are most of the people. Most of the people in journalism aren't Julia La Roche. They aren't people who generate value in and of their own volition and are able to build their own businesses independently and charge for the value they create. Most of the people in journalism, as you know, don't inhabit that part of the world because you've taken risk, because you've taken your future into your own hands. You will come out of the next 10 years, provided that you invest intelligently and don't spend beyond your means. You'll come out of this in fairly good shape. It's just that much of your audience, pardon me, won't.
I hope, yeah, I got to work on my sales a bit. I'm still trying to work and grow this business, Rick, and monetize it and all of that. But I am grateful to be on this journey. And I'm also grateful for amazing guests like yourself and this wonderful audience that allows me to do something and be independent and free and able to have who I want to have on the show and ask the questions that I want to ask. And more importantly, give guests time to answer questions versus everyone just gets crushed into these little sound bites. And
right.
I'm not a soundbite girl. I love to listen.
Thank you.
I want to bring up another topic with you because when we were talking about different warning signs, you also mentioned like the stock market and that it's really, 10 or 12 stocks that are kind of running it right now. But there are some value stocks that are there. And they might be more in favor, if we saw that decline, than, as you put it, the glamour stocks, which I liked that phrase. Let's kind of drill down, if you don't mind. Can we explore some of the opportunities, kind of how you might want to be, or how are you thinking about this environment or what you're favoring? Anything that you can share, no pressure whatsoever, but whatever you're willing to share, we'd love to hear.
Some sectors are cheap. Oil and gas is cheap. It's priced like the big thinkers, Joe Biden and Angela Merkel, were right. It's priced like the oil and gas business is going to go out of business in 2030. Except it's not. It's going to continue to 2065 or 2070. So the oil stocks are cheap. And I think a Trump presidency probably is good for the oil business in that some of the really idiotic de facto regulations of the Biden administration will have gone the way of the dodo. Wholesale property and casualty businesses are cheap. The industry is getting sold off very hard now as a consequence of the California fires.
Yeah.
And I'm not so sure that I would want to be in the retail property and casualty business, which is to say I wouldn't want to be an auto insurer or even a home insurer. But commercial insurance and reinsurance is cheap, 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 cheap. Small community banks are cheap. There are a number of sectors out there that are cheap. I don't know them all, so I don't participate in them. I understand natural resources and I understand conventional financial services, and I don't get tempted. I don't get drawn out of things that I know well. But I can tell you that banks with below $1 billion market capitalization appear to be very, very, very good value. The big property casualty insurers and the little ones, I think, are really, really good value. Some of the global miners are decent value. The oil and gas business, particularly the Canadian oil and gas business, is really cheap. I mean, something important is happening in Canada.
Oh, yeah. Explain that. Yeah.
The prime minister has decided to pursue other employment opportunities.
Yep. I wanted to ask you about that.
That's a very good thing for the Canadian oil and gas industry. The prime minister didn't believe there was a business case selling Canadian natural gas, which in Alberta is priced at about $2 per million BTU, to Rotterdam or Shanghai, where that same gas is priced at $13.50 per million BTU. Somehow that math didn't appeal to the prime minister, nor did he believe that there was a business case to sell something to Germans, Japanese, or Chinese who were eager to buy it. His decision to pursue other employment opportunities lifts the lid on the Canadian oil and gas industry, which I think is absolutely wonderful. I also think that there's a possibility that whoever succeeds Mr. Trudeau and the Trump administration makes access and egress for Canadian heavy oil and Canadian natural gas through U.S. distribution and liquefaction systems easier, which means that the Canadian oil and gas industry would receive, if you will, a double benefit. At any rate, if nothing changes, it's cheap.
Yeah. I know you've spent time in Canada. You're educated there. You've worked there. What do you think is going to happen there politically? Do you have any probabilities or outlooks?
I think that Trudeau really truly has worn out his welcome. And I suspect that his successor will be the conservative candidate, Poilievre.
Mm-hmm.
I don't know much about Poilievre. He seems to have run for 2 years against Trudeau rather than for anything. Probably the right thing to do politically. It'll be interesting to see what he's for as opposed to what he's against. I note with caution that Canadian voting tendency is to the left of what I would prefer. What I call the consolidated left in Canada, the NDP, which is a traditional socialist party, the Liberals, who are also a socialist party in practice, the Bloc Québécois, which is a regional French-Canadian political party, which also has socialist leanings, and the Greens. I call them watermelons, green on the outside, but pink in the middle. That group of four parties regularly commands between 60 and 62% of the Canadian vote. So that the broad narrative of Mr. Trudeau is broadly popular in Canada. His arrogance and his inefficiency means that his rankings in popularity polls now is below 20%. We've seen this before. Canada did forsake the left in the aftermath of the current prime minister's father's reign in power. In other words, Canada seems fond of socialists until they can't afford them anymore. Then they thank and excuse them. They have 10 or 12 years of fiscal sanity running the ship. And then as soon as they can afford to, they vote for the left again. So I guess my estimate now is that past is prologue, that the Liberals will be out of office. And by the way, we won't have smaller government with the Conservatives. They won't cut the size of government. They'll just slow the rate of expenditure. And I think on balance, that'll be good for Canada.
Let's sum up just this episode before I let you go. Going back to the economy, you shared that you were surprised by the relative strength,
Yep.
both in the US and the global economy. So my question for you is, are you cautious now? Like, if you were surprised by the strength, how do you kind of describe how you are right now? Does it make you cautious? And if so, could you kind of contextualize that?
I am cautious. I have cash as a larger component of my portfolio than I would like. When I say larger than I would like, I don't like the fact that I'm earning 4% or 4.5% on savings in a currency that's depreciating by 7.5% a year. But I regard the foregone purchasing power that happens holding cash, pardon me, as an option payment. I want to have the liquidity so that to the extent that we have a liquidity squeeze occasioned by the difficulties that I see in the economy, that I can take an advantage of that liquidity squeeze rather than being taken advantage of. I'm trying to help as many young people as I can, first of all, understand that their future is, while not unpromising, less easy. To the extent that young people can increase savings, to the extent that they can trade a variable rate mortgage for a fixed rate mortgage, to the extent that they can trade in a wage slave job for controlling their own future, getting paid for the value that they create, rather than necessarily the value that they create for shareholders. That is, create value for your customer as opposed necessarily for your employer. I'm trying to encourage young people to do that actively. I'm a director of something called Students for Liberty, which talked to 160,000 students worldwide last year about why government is not their friend, about why they need to take control of their own employment future, their own financial future. I'm actively doing that. I'm going to be fine. You know, I got through the decade of the 70s. I've got through lots of stuff. The truth is, I don't have all that much time left on Earth. I know how to deal with this. I have ample reserves. I have great contacts. People like me, or at least some do. It's younger people that I'm concerned for, and younger people that I try to address with messages like this and with my philanthropic work, with my mentoring work.
Yeah. Well, Rick, we always appreciate you coming on this show and, getting to talk to that audience, folks who are millennials and Gen Z as well. I know they will certainly appreciate your insights. Before I let you go, let's have some closing thoughts for the audience. Anything that you'd like to leave with them to think about? I know you have a boot camp and a symposium. I would love for you, if you don't mind, share more about what you have going on there and anything else that you would like to plug or leave this audience to think about. The floor is all yours.
Take control of your future. That's the most important thing. Don't rely on society to do it for you, because the Commonwealth, frankly, is empty. I mean, just get that through your head. Own gold. Own gold, and pray to God I'm wrong. As an investor, as a saver, have gold for insurance purposes. Hope it doesn't go up, but be prepared if it does. If you're an investor, consider buying the best gold stocks. If you're a speculator, look at the penny dreadfuls. There's lots of money to be made there if you're willing to work and take the risk. Beyond that, invest in the biggest and best oil and gas companies, the great dividend payers. Warren Buffett is going to 30% on Occidental Petroleum. How many times has he been wrong? Not very many times in my life. If you are invested in natural resources, take advantage of a free service offered by me. Go to my website, ruralinvestmentmedia.com, list your natural resource stocks, and for free, I'll rank them 1 to 10, 1 being best, 10 being worst. That's free, no obligation, ruralinvestmentmedia.com. If you want to learn more about investing in natural resources, then you got to pay me. Every quarter, I have a boot camp. It's an 8-hour-long deep dive into one aspect of natural resource investing. We just did gold part 1. Upcoming, because I think it's important, we have gold part 2. Gold part 1 was savings in gold, owning physical gold. Gold part 2 is investing in gold. Gold part 3 will be speculating in gold. Those are 8-hour-long deep dive sessions. Don't come if you're a tourist. Don't come if when you buy the paper, you buy it to read the funnies. But if you really, 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 really want to learn about gold, you will spend 8 hours in a session. You'll have access to the recordings for a year, and you'll need them because you'll have to pay the recordings twice to get all the information out that we gave you in the original 8 hours. And by the way, there's an absolute money-back guarantee. If you attend the boot camps and you don't think you got your money's worth, just tell me. I'll give you your money back. And then finally, if you're really a natural resource enthusiast, really a gold enthusiast, every year now for, I believe it's 29 years, we've had a symposium. This year it's in Boca Raton, Florida. It's the Natural Resources Investment Symposium. It's July 7 through 11. You can attend in person, which I encourage, or join over 1,000 people and attending online. This is a 4-day session, 12 hours a day, 48 hours. Again, if you don't think you got your money's worth, we'll absolutely positively refund your money. This is financially an absolutely riskless transaction, but only come if you're prepared to work. Once again, we'll have the recordings of this conference so that you will be able to, and in fact, you will have to, rather than spending 48 hours, be prepared to spend 150 hours, which is to say, watch the proceedings and then watch them twice more from the comfort and convenience of your own home. Whether you attend live or whether you attend via live stream, there's an absolute gold-plated money-back guarantee.
Well, we will leave those links in the show notes for folks who are interested in attending the boot camp and the symposium. And Rick Rule, President and CEO of Rule Investment Media and co-founder of Battle Bank, thank you so much for being so generous with your time, all of your knowledge and your wisdom and your ideas and insights. We really appreciate you stopping by. We love having you on the show. We're so excited to have you on and do that quarterly check-in. Thank you again, Rick Rule.
Always a pleasure. And if you remind me, I will ask David Stockman
I would
to
love
expand
that.
his audience. He's a good friend of mine. He's a wonderful guy.
Thank you so much. I think this audience would enjoy that as well. Thank you again, Rick.
They should.